saying is that what is your market experience in terms of your own trading personality? Have you discovered that? Are you one to be looking at a lower time frame or a higher time frame? Do you like looking at continuations or do you like looking at reversals? Would you rather be in a consolidation or in a trending market? So these are the type of questions you want to be asking yourself, Coley, and then that'll help answer some of the tools that might assist you in your approach.
Yeah,
So that's
exactly.
that's the real sauce. Well, if you're looking to just say 1 to 5 minutes and just to pass an Apex account, then that doesn't really tell me a lot about your trading personality. Um, but are you interested to expand on that? Because I am down to help you, but as much information as you can provide, is what I can also lean to give you as the best of guidance, right? So if you're looking just for a lower time frame, then again, there's plenty of tools that suit the lower time frame.
Yeah,
But you got
definitely.
to be a little bit more specific. If you're just looking to pass an account, again, I would just say that you want to respect your process, and then the rest will come into play. Because if you're so focused on passing the account, then you're putting all of your energy on that occurrence as an event, and not necessarily so much of the process in order to get to that. So just real talk. And Coley, please, definitely let us know. Speak up, because we're happy to help out, but you got to be a little bit more specific. So, an MMXM indicator, that's basically the fractal consolidations. That's going to be your favorite right there.
Yeah.
If you are a MMXM trader. So I wouldn't recommend saying that, everybody needs to watch the core content videos. Um, I personally believe that, T Trades does a very, very good job explaining tons of concepts. But for those that are wanting to be more thorough and understand you know, a totality approach, then the core content is suitable for them. But it's more or less like let's call it like a college level class. That's the way that I would see it.
Yeah,
But if
definitely.
you want to see the spark notes of the college level class and or insights from those that have already taken the test and have already passed the test of that college course, then I would definitely say that T Trades does a great job with that. And if you guys have questions about the fractals, then T-Trade's fractal model would probably be your best understanding or starting point. And then the moment that you guys have specific questions about that tool, you could always tag T-Trades in the general chat and or also watch, I think he has almost 15 or 12 to 15 different videos in a specific playlist about the fractal model. So if you have not visited his YouTube, um, definitely join one of 330,000 subscribers plus now and counting that have been came across his channel and have learned something from him. So
That's
if
some
you don't
solid
know what
advice.
exactly hours to trade, that's gonna be basis of saying where your market hours suit your own trading schedule, right? So if everybody and their mothers are trading at 9:30, but you can't be at the markets at 9:30, then you shouldn't be trading off of your phone because you don't have the right concentration to be at the desk at that time. And to say that, someone needs a specific time to get involved with the market, I'll definitely resort to saying that you can check out the DTT intraday tools because those tools are very special in the fact that they break down the entire 23-hour trading day into specific time models. And you're able to then look at those specific time models and become a specialist at those specific time windows. So if your trading schedule doesn't permit a normal market hours RTH schedule, then there are other tools that will allow you to be assisted throughout that process. So that's awesome.
Right. I think we have waited long enough for people to join in. and we can start, right? First things off,
Awesome.
first things first, I kind of want to, because I'm going to build upon something else here, right? I want to know that if everyone that has a yellow name in the chat, I want you to know that we recently released the latest end of month recap report. And if you haven't checked it out yet, definitely do so. It's always filled with insights on, what shaped the previous month and what we expect, or kind of what we are looking for the next month or next upcoming months. So just know, if you have a yellow name, if you have the Elite Collection, you have access to it for free. So definitely go check it out in the library, 2 Degrees library on WOP. Because it's just extra value that you don't have to pay extra for if you have the Elite Collection. Are you yellow? You are, it seems. So that means wop.com/2 degrees, you'll be able to access it. Today I wanted to do a little bit of an overview. I know most people here trade the indices markets, right? Type a 1 in the chat if you trade the indices markets or the US index futures. No, it's going to be a lot of ones, probably. Okay. And now type a 2 in the chat if you can agree with me on that the past few, let's say, past few weeks have been a little bit of a slow grind on NQ if we look at the higher time frame. It's not very clear, not unclear. It's just going, but not very fast, not very slow. It's just doing its thing, right? Exactly. So there's a lot of people that probably feel the same way as I do, right? And today I'm going to provide a little bit of context as to why that maybe is, might be happening, as to how or what the reasoning behind it might be, you know. So first things first, we're going to look at one of my favorite tools. We're going to look at a little bit of the COT today, and just for the people that don't know what the COT is, basically it's a report that is issued by the CFTC, and that's the Commission of Future Trading. I'm not sure what the acronym is here, but basically it's a snapshot that provides a overview of all the positions of certain categories of traders, right? Which would be non-commercials, commercial traders, and non-reportables, which would be us, small-time traders. Yeah, the Commodity Futures Trading Commission. That's it. Thank you, Josh, for the assist. Appreciate it. Type a 1 in the chat if you have never heard of this, the COT report. Okay, there's a few people in here that don't know about the COT, it seems. So I'm gonna do a little bit more of an explanation so you guys can, follow along as well. You don't need to watch other videos first before being able to understand my presentation today. Basically, what it is, the COT has 3 categories, right? Non-commercials, commercials, and non-reportables. If someone is a commercial trader, right, it means someone has a business interest into a market. Let's say we have a commodity market. Let's say we have a corn market, right? If someone has a business affiliation with the corn market, it most likely means, oh yeah, I'm recording, don't worry. It most likely means they have something to do in their business with corn. They might be a farmer, right? They might sell corn. They might be, let's say, working for a factory that uses corn in its production, for example, right? They all have a commercial interest in the market. Then we have non-commercials, right, which are speculators. These are people that do not have a commercial interest in the market, but just like to speculate on whether the price is going to go up or going to go down, right? But they are non-commercial because they're quite big, right? These could be very large parties, right? Could be, for example, let's say a large hedge fund, for example. Could be a non-commercial, right? They don't have an interest in the market as to corn. They're not interested in actual physical corn, but they are interested in what the price is going to do. And then we have the non-reportables, which are small traders. And we are kind of the same. We don't have a business interest in the core market. We just like to know if it's going to go up or down, right? And the positions of each of these categories are displayed into a report every single week, right? Because these bigger parties are obligated to tell their positions or to send out the positions they have to the CFTC, so the CFTC can enforce if everything is going to go according to the rules of the SEC, for example. If there's no any forbidden trading practices such as, I don't know, whitewashing or whatever. And non-reportables, those are just done by sample. Not every non-reportable is being asked what their position is, right? I'm sure most of us never have had the CFTC on our door asking what trades we have open, right? That doesn't happen like that. They just communicate with brokers. Anyway, we can use these reports to kind of get an insight as to what did the big players do in the last week. Did they open positions? Did they close them? And then we need to find out why, right? So do keep in mind it's a little bit of a lagging indicator because we are always 1 week behind or a few days behind. But it doesn't mean it doesn't give us any invaluable intel, right? Because it's very valuable in my opinion. Because basically when we are looking at a lower time frame, we are kind of doing guesswork at the end of the day as to what we expect the market to do, right? When we see a market diving into a discounted price and we expect it to go to a premium again, that's, we kind of formulate a hypothesis in our mind where we expect smart money to do certain things in discount to take it back into premium, right? But with this, we can actually see what is actually happening behind the scenes, right? We can have an idea and then we can basically confirm it. Are they actually building positions that support that idea or not, right? So that's what we use this report for. So just to show you, this is the NQ chart, right? That we have at the moment, a daily chart. And this is a COT report, but then displayed in a graph instead of the actual numbers that come out every week. And this graph represents the total net positions that they have, right? So they can have long positions and short positions, right? And if we subtract them from each other, we get a net position, right? It could be that, for example, speculators or hedgers or whoever have open, let's say, 100 shorts, but they also have 80 longs, right? It would mean they have a total net position of 20 short, right? That's pretty understandable, I think. Now, what we could see here on NQ, this is, by the way, this is the commercials that we're looking at, right? And then we have a 6-month look-back period that is depicted by the premium and discount. We have a horizontal line up here, which is the net zero line, which means whenever this graph is at the net zero line, it means they are basically neutral on the long term, right? They have as much longs as much shorts open at the same time. So right now we can see that they are pretty far below the net zero line, right? Which would mean they have a large net short position open instead of a large net long position, right? And what we could see here is a buildup of a long position, right? And what we can see here is unwinding long positions, right? Makes sense. We can see how on the sell side of the curve in a buy model, they are actually starting to buy more and more and more all this part up until we get into a premium area right here, and we can see that they slowly start to unwind their positions right here, right? And we can see here that the activity kind of becomes flat, right? It doesn't do a lot of anymore, right? It kind of stays the same. They go up a little bit, they go down a little bit, but it's not like big movements like we've seen before right here, right? Around here. So what we could see, and this is a summary of the latest report. In the latest report, the hedgers, they trimmed both their long and short exposure, which means they potentially are reducing risk or just flattening their positions, right? And these are basically the commercials, right? These are the ones that we want to follow. Now, the first thing we have to ask ourselves is why would they be trimming their long and shorts, right? In a time like this, markets going up, seemingly markets go up forever. They are stock markets. We expect them to go up for like forever. That's not financial advice, just a joke. Well, one thing that comes into my mind as to why they would be doing this is the fact that it's August, right? In the summer, usually volume tends to die down a little bit, right? People go on vacation, and the same way hedge funds also slow down a little bit. Large institutional players, they slow down a little bit in the summer, right? Because there's not much interest in markets because a lot of people are on vacation. A lot of people are not doing anything with markets, right? They still run, of course, but overall there's just less participation, right? If you would pull up a seasonal tendency chart, you would also see that you usually see sideways seasonal tendency or consolidated profiles somewhere around the summer, right? So if hedgers know the fact that the coming month most likely volatility is expected to be lower, or we expect the summer to be slower, there's no reason for them to expose themselves to risk unnecessarily, right? So they will actually close positions, and it's not a bearish or a bullish sign. They will just actually close it just to reduce the risk on what they have on the table, right? Because if there is no reason to actually keep open a lot of risk, why keep it open, right? If you're gonna be in a trade and you for a fact know because the last 20 years a certain time period didn't do anything, would you keep the risk open, or would you be like, I can close the risk off and I can come back later when I know that there's supposedly more volatility coming in, right? So that's what my idea is or my view as to why they are slowly, um, basically flattening their position overall. Now, the speculators on the other side, they added positions on both sides, right? More on the short side, indicating that they might be cautious, or it could be hedging driven activity rather than a directional bet. So the funny thing is, usually we'll see that hedgers and speculators do the complete opposite thing, right? And usually we want to follow the hedgers and we want to um, basically be a contrarian on the speculator side, right? Whatever they do, we want to do the opposite of them. That is in the right circumstance, right? Because speculators, who are these people, they are large trading firms, right? And they have a little bit of a different philosophy to trading or position management than we do, right? Let's say we have a large hedge fund, right? They are not going to be entering their trade on the 1 minute with, let's say, 10 NQ contracts and just, letting it ride for 15 minutes and then uh, target a liquidity pool and be done for the day, right? No, they build large cases, and if they build a position, as in like an investment position, they will keep a trade open for a longer extended period of time, basically riding a trend, right? So a speculator, for example, would be entering a trade right inside here, for example, and try to ride out the trend for as long as possible until there are signs that the trend is no longer going to sustain. So in these trends, these speculators are still profitable, right? Because the earlier speculators that get into the trend early, they still make money, right? It's only at the top or at a bottom where a trend tries to reverse is where basically speculators that are late to the party will actually turn a loss instead of a profit, right? Makes sense. Early bird gets the worm. And then the small traders, they increase their long exposure notably, right? So what do we know? Retail traders are very optimistic on NQ, expecting it to go higher, but the net change remains pretty modest, right? It's not a big increase or something. So we know that small traders are pretty optimistic about NQ. We know that speculators are not really doing a lot, and we know that hedgers are not really doing a lot, right? So now you need to ask yourself, okay, let's say NQ goes up significantly, right? We get very large candles. Who fuels that move, right? We need to understand that if there's no money behind a move, there's no interest inside a move, there's probably no conviction behind a move, right? So right now, we see that NQ is going higher slowly but surely, just because there's not really like a lot of interest in the market, right? Because the big boys are kind of keeping their hands off and really just waiting and seeing what's going to happen, right? As to specifically placing a directional bet. Now, any questions, by the way, about this before we move on to ES? Let me know. So now's the time to ask before we move on. Reminds you of your college courses. What did you study that you had the COT? How do we know what the groups are doing? Well, basically, this indicator from 2 degrees, which is a free one, by the way, shows you the net position of the hedgers, right? Which is the most important one. We can do just fine without these two. I like to add them in the presentation, but we can basically work with just the hedgers because those are the guys we want to follow, and those are the most important. It's the most important information that we have. At bar chart, what's the difference between COD LC and COD FTR? I think that's legacy versus something else. And the legacy is basically what we are looking at right now. That's, yeah, so COTFR is 4 different groups. I think it's like dealers, large speculators, small speculators, something like that. But I use the legacy one. And the legacy one is the non-commercials, commercials, and small speculators. And the other one is just basically a newer, updated version that has divided the groups a little bit differently. I don't use it because I personally follow the way that Larry Williams used to teach the COT, and he uses the legacy report, so I just stick to that. Let me see what the other one was. Yeah, so we have legacy and then we have the other one. I don't, yeah, use the other one personally. Yeah, then we have dealer, intermediary, asset manager, or institutional, leverage funds, and other reportables and non-reportables. So it's a slightly bigger division, but I just use the one that's divided into 3 groups. Makes it easier. But good question though, because could be very confusing if you're looking at it for the first time. You know, which one should you pick and why? So open interest and COT can be not equal because open interest is the total of all outstanding contracts, right? Everything on the market. And in these reports, it could be that, we only see a part of it because we don't see all the different ones, right? But usually it should be quite close. In 820 versus only 132K on commercials and only 140K on non-commercials is a pretty big difference because that would mean that more than half of open interest would be in the hands of non-reportables, and the ones that actually don't get counted or don't get sampled. So that I don't think that should be correct from what I could read from the message. Let's go to ES in the meantime. Let's see if someone still has questions. Oh, you did a finance major, but worked closely with PhD students, along with the rest of finance faculty after being introduced by Empire. That's cool, man. Love it. I wish I did a finance major. Yeah, so what we can see, so another thing about it is we have let's see, yeah, it's minus 164 and minus 115. So the thing is, in a graph like this, it shows the net position, right? So they might have, let's say, 130K longs open, right? The commercials. But that's the net position, right? It could, for all we know, because we can read it from a graph, they could have 400,000 shorts and 532,000 longs, right? And then we are suddenly, we see net position is 132K, but below the surface in the report, it's actually like 500K report total positions, right? So there could be a lot of hidden positions on the other side as well, because they're never just positioned on one side, right? They're never only 132k long, right? It means they're probably also a large amount of shorts on the other side, but they're just more long than short, so net position will be net 130k. So that's why there's a big difference between it. So let's see. We also have ES, right? And ES paints a little bit of a different story than NQ. Overall, NQ is the more volatile asset, and in the COT, we could also see that, right? Overall, I'd say NQ is seen as a little slightly more riskier asset, right? Because it's more narrowly focused on the type of companies. It's only tech companies, and it's only 100 of them, right? So let's say someone invests in a Nasdaq, it means they are less diversified, right? They are essentially, um, bottom line, they are exposed to slightly more risk, right? Whereas if someone invests into the S&P, he is investing into um, a much broader and larger index, that consists out of 500 companies and not only tech companies, right? So it's also sector divided or diversified, right? So what we could see is indeed, large players kind of cutting down their risk on ES or NQ, sorry. And what we can see on the latest report for ES is that all three groups reduce both long and short exposure, right? So we could see is a general de-risking across the book, right? All three are basically, um, slightly de-risking. What we can see, that's right here, right? That they're kind of closing positions on both sides. Um, However, the speculators shed significantly or closed significantly more shorts, which could indicate some repositioning or potentially taking profits on speculative trades, right? Let's say a speculative position was open right here and they start to close long positions right here. It does not mean they are closing longs and therefore they are bearish. It could also just mean, we've had these longs open for quite some time now. Um, who knows? Maybe they have leverage funds, right? And they need to pay interest on them. So it's not worth it for them to keep it open any longer. Or maybe they are just seeing certain things in the market, or maybe they have a specific profit taking strategy and they start to close longs in premium end, right? And the hedgers, they pulled back exposure, and which is likely a reflection of the market easing, um, conviction, or a risk reduction by institutional players, right? Really, is paper empirical performance of alternative option pricing models is one of or might still be the most cited paper in finance. Funny thing is, I know the paper. I think I read the summary once. Yeah, it's probably very famous. Oh, interestingly, was your professor though. That's cool stuff. Now, we looked a little bit at the COT, right? We looked a little bit at how, we can look at different type of trading groups or groups of traders, and how we can interpret their positioning, how we can interpret what they're doing. So basically, the bottom line that we're looking at right now is that both or most of the parties are all just slowing down a little bit, right? Most likely because of the summer, most likely because there's not really a lot of drivers or economical drivers at this point. Um, but we're going to take a look at that in a little bit. First, we're going to switch to another tool that we have to use in accordance with the COT or together with the COT, which is called open interest. And type a 1 in the chat if you've never heard of open interest. Let's see if anyone knows or does not know. So everyone knows what open interest is, or are people just a little bit slower? I hinted at it in previous questions. I did indeed. Maybe people have figured out in the meantime. Who knows? Maybe we know it wrong. Well, you never know. I'll just I'll just give us a short explanation. Basically, we have volume and we have open interest, right? And volume is the amount of contracts that are traded throughout the day, and open interest is the amount of contracts that are still open by the end of the day, right? It's interest that is still open. That's why open interest. You would compare to a pool. Let's say we have a swimming pool, public swimming pool. All the people that come and go and take a swim during the day, that's volume. All the people that are still inside the swimming pool at the end of the day when it's starting to close, that's open interest, right? So why is open interest important? Well, it shows us basically the positions that are open for a longer term, probably, right? Which would be the positions from the larger speculators or hedgers, right? It's a good analogy, yeah, because it makes it easy. Everyone understands if someone comes and goes to a swimming pool, right? So, and why is it important to use open interest together with the COT, right? Picture this. Let's say you know what the COT is doing, you know where they are basically going long, going short, you know what's happening. But you don't, let's say there's a large move on NQ, right? Well, we want to know, is there actually money behind the move? Like I said earlier, is there interest behind the move? Open interest will tell us that, right? And open interest will then also tell us who is behind the move, right? Is it speculators, so non-commercials, or is it commercials that are behind the move? It's pretty important, right? Let's go to NQ. So what we can see here is a graph which is basically open interest, right? And as I said, this is total outstanding amount of contracts on NQ. And what we could see is the slow grind up on NQ here with barely any movement, but it just closes slightly higher every once in a while, right? And what we'll see here is that, it makes sense because there's no real new money coming into the market, right? It's slowly going up, yes, but there isn't a lot of speculative interest, right? What we need or what we want to see for before we can say, hey, this market is definitely gonna go a few legs higher, or there's definitely a lot more interest in this market, is we need to see this graph go up, right? Because if this graph starts to go up, it means more positions are being opened and being held open. So there's more interest in the market, right? Because if no one's interested, it means there's no new money coming in. So it means the market won't go up properly, right? It might give us a slow grind higher, but it's not what we're looking for, right? What we can also see, which is a very important thing, is these large drops here, right? Large drops in open interest. Drop a 1 if you do not know what these drops mean. Why open interest just dips suddenly like crazy. Why there's a big amount of contracts being closed from one day or another. Kind of weird, right? Yeah, think about the calendar. It's very simple. It's very simple, and I'll tell you. These are just the contract switches, right? We trade NQ on quarterly contracts. So it's indeed the expiration. So what happens is, let's say someone chooses to have a trade open right here, right? Right here. And they let the trade run, right, all the way until the expiration. Well, that person can then choose, do I want to roll over my contract to the next, or roll over my trade to the next contract, or will I just let it expire, right? Well, a bunch of people will most likely choose to keep open their trade and just roll it over to the next trade, right? Or to the next contract. And that's why open interest always dips, but does not go to zero, right? You can see that it always stays a little bit higher because there's always people going to be still interested into the market, right? But at the same time, there's a lot of people that are going to be like, I'll just let it expire. I'm done with my trade. I traded it for an entire contract or entire expiration date, so it's fine for me, right? And then they just leave the trade be, and the contract ends and their trade ends with it, right? And that's why we see a big drop in open interest. But usually we expect the market to kind of try to pick up where it left and new people come in, and that's where open interest starts to rise again. So it's a very simple thing, but it's important to know so you don't freak out as to why open interest is suddenly dropping. Not that you're going to think, a lot of people are suddenly losing interest in the market. So what we could see is a clear buildup in positions, right? We can see a clear buildup, but it's shallow, right? It suggests growing market participation, a little bit of conviction, but it's not too convincing to me. The indicator for this is seasonal open interest, also from 2 degrees, also free. A lot of free stuff this stream. Now, likely when we have that open interest is rising and the market is going up too, it usually fuels trend continuation, right? If price aligns. If open interest goes up while the market goes down, same thing, it means it's fueling the trend, right? Rising open interest paired with strong price action would indicate momentum and not exhaustion. But here we kind of see that markets are not really moving that strongly, right? It's kind of slow. Then we have ES. And what we can see in ES is a very different picture. We can see that ES is seeing diminishing open interest, so either suggesting position exits or maybe the trend is weakening. We don't know yet, right? Because we cannot just tell that a trend is weakening or that an asset is about to reverse or that a top is being in just based on a few things, right? We need a lot of confluence and a lot of information to really make a decision on that, right? And with just this info, just the COT and the open interest, yes, we can anticipate trend reversals, but usually we need a little bit more information just to make an educated decision, right? Or guess. If paired with sideways or choppy price action, this aligns with structural hesitation. Or consolidation. What we can see is pretty choppy price action and this going down. And if price moves strongly but open interest falls, usually it reflects a lack of conviction behind the move. Could be a red flag for sustainability, right? So what I said earlier, there needs to be money on the table for the move for it to be convincing, right? Otherwise, it wouldn't convince me, right? If a market as big as this starts to go up, there is someone that needs to put money on the table for it to go up, right? It can't just rise out of nowhere. If it does, it's probably unsustainable, usually. Any questions so far about open interest, about COT, about anything we've talked about so far, or maybe anything else? And let me get you the link for the indicator, by the way. There you go. So yeah, let me know any questions if you have them. If not, then we can continue. I'm gonna give it a minute. Okay. I think no questions so far.
One, if you're still with us, I want to make sure that everyone's still with us. Make sure you drop a one.
Let's go. People are still
I
here.
want to make sure that we're all still here, listening, ready to go on.
Perfect. Good to hear. Okay. So, what could be something that we could look at in order to understand why large players are doing what they are doing now? What could be something that we have to look at in order to understand? And also from their perspective, they're not looking at what the next day is going to do, right? They're thinking ahead. What is going to come in the next couple of months, in the next year? What are we expecting? And how are we going to position ourselves to align with what we are expecting for the coming 3, 6, 12 months, right? What could we look at? What would be a deciding thing for us to judge what a market could do? And you have to look a little bit at the context as to where these markets are operating. Anyone take a guess? What could we look at? Or what's important? Josh already gave us a very important thing. Boom. Someone gave the perfect answer. Economic context. Perfect. We need to understand why are large traders making the decisions they are making right now. Right? And the answer is economic context. If an economy is isn't doing well, let's say hypothetically, and it's not true, the US economy would be shit, total shit right now. Would investors put their money on the line for a rising that they expected a rising stock market? Most likely not, right? Because if the economy isn't doing anything, most likely money isn't going to be flowing through it. Most likely businesses are not going to grow, so stock markets are not going to go up, right? Other way around, let's say the US economy is doing phenomenal, is doing better than ever before. Would investors be likely to throw money on the table to try and capitalize on the economy growing, capitalize on businesses expanding, and more money coming into the economy? Most likely, yes, right? And then we'd see NQ go up crazy, right? And there's a lot of things that depend or that shape that context, of course. But look at where we are now. Yes, we're going up, we're not going down, but stock markets are usually supposed to go up, right? Because they are a sign of the economy growing in a sense, or part of it. So it isn't bad, but it's also not super good, right? Because it isn't showing pace, it's not showing momentum. So what could likely be happening? Most likely, paired with the summer seasonal where markets slow down, investors might be not really sure what's coming next, right? For example, we have in the US economy, we have growth, right? Which is GDP growth, gross domestic product, which is basically a number that tells us if the economy is growing, yes or no, right? And what happened is that the US economy growth did go up again, right? So it went from neutral to mild positive. We have inflation, which is also important for the interest rate triad indeed. Bless this mess. Thank you. Interest rate triads. And we had, which was sticky in services and a surprise in PPI, which led to a hawkish risk. What this means is basically inflation went up. And if inflation goes up, the Federal Reserve is less likely to cut down interest rates, right? Because higher interest rates lead to lower inflation, right? And they have a target of 2%. And if the data starts to tell, it might be above 2% right now, and we don't foresee it going back down, there's no reason for them to cut down the interest rate, right? Which is something we need for this market to go up. Then we have the job market, aka labor market, and it was resilient, right? Which is good. That's a good thing for NQ. It means people are spending money in the economy, support spending. So that kind of leads us to think, okay, that might bring us closer to a rate cut, right? Because more rate cuts means more spending, right? Then we have policy. And the policy is the Fed is a little bit cautious. Markets are more dovish. And why are they cautious? Well, because inflation was kind of sticky, right? So they are kind of dovish. But at the same time, labor markets are resilient, right? So it could lead to potential volatility. And then we have the risk, which is stagflation and deflation scenarios, and those are tail risks. Any questions about anything of this as to why the Fed might be cautious? Anyone knows? Anyone doesn't know? Type a 1 in the chat if you do not know why the Fed is cautious at this point. Because this is important stuff if you want to know or identify. Let's say your strategy, you trade intraday markets, right? How do you know if intraday markets are going to be volatile or not, right? You do not know if the market's going to be volatile on a weekly basis just by looking at liquidity pools, right? Because it could take 1 week to reach a liquidity pool, but it could also take 2 months or an hour, right? So those things, they are important factors, yes, but they won't tell you if you can anticipate volatility, yes or no, right? That's this stuff. So we have the risk of Powell, is he going to be there or not with the Jackson Hole event coming up? But the main thing as to why they are cautious is the fact that inflation is sticky, right? Basically, the central bank, which is the Federal Reserve in this case for the United States, they have this lever that they can, or let's say they have a gas pedal and a brake pedal, right? And the brake pedal represents hiking rates, aka higher interest rates, right? And the gas pedal represents cutting down rates, right? Is that clear why cutting down rates means speeding up an economy and why hiring your rates means slowing down an economy? Type a 1 in the chat if you do not know why, because I'll help you understand within 1 minute. Yeah, exactly. If interest rates are lower, borrowing money will be cheaper, which means people are more likely to take out loans, which means people are more likely to spend, which means an economy will grow, right? Which leads to inflation eventually. And if inflation gets out of hand, well, they need to slow down the economy because inflation is going too crazy. And then they will hike the interest rates, aka get higher interest rates, which means people are going to pay more money to borrow money, right? They got to pay more. So people are less likely to borrow, which just slows down the economy eventually. And that's why we have economic cycles. So the thing we have to look at now is the fact, are we going to get an interest rate cut? Yes or no? Right? And this whole year, we haven't had one, right? The last one was last year. And every single FOMC session or meeting, everyone's patiently waiting for Powell to announce that, are we going to cut rates? Yes or no? And every single time, Powell kind of gives off the same message. We're looking at the data. We are being cautious. But we're not cutting rates yet, right? And then we have Donald Trump in the corner screaming that he wants a rate cut. So that also adds some spice to the mix, it's not something we see often that a president tries to, how can I say, mess with the interest rate, so to say, or wants to involve himself with it, because usually that's the job of the central bank. That's why they're there. So it's important to notice because now we understand, okay, if the Federal Reserve just does not know when they are going to cut interest rates, we do not know when jobs are or when markets are going to go higher, right? Yeah, Trump's plan to print money for that, he needs lower interest rates to involve international investors. Yeah, that's the thing, right? Right now, yes, we have tariffs, but at the same time, the US dollar is plummeting downwards, right? Which kind of cancels it out for foreigners, right? Because if let's say you didn't have to pay tariffs, but you had to pay an expensive dollar. Now you have to pay tariffs, but a cheap dollar, right? Which kind of cancels it out a little bit. Yeah, and also the whole debt system. Let's say the U.S. economy, well, the U.S. has to pay debt this year. They can refinance that debt, right? But against what price do they have to refinance it? If the interest rates are high, they have to refinance it against a higher interest rate. If they have low interest rates, it means they would have to refinance it against a lower interest rate, which would be cheaper in the long run for them. So that's probably also why he's pushing for lower interest rates. But at the end of the day, me, you, all the guys on Wall Street, everyone it's we don't know for sure, right? We don't exactly know what's going on in everyone's head. But the government, we cannot know their future steps unless they tell us or accept from what they tell us. So it's all a little bit of guesswork, educated guesswork, so to say, because we can expect certain things to happen because we can understand implications of certain decisions, right? Now, I want to keep this last part of the presentation open because this was the presentation, and I want to know if there's any asset, anything, or anything else you want to ask or want me to look at. Because in this presentation, I just wanted to give you guys a bit of an overview as to what's happening, why is the market doing what it's doing now, because a lot of people, I saw that a lot of people did not understand the slow grind, right? Why is the market going so slowly now, right? We can talk about yield curves. Yeah, for sure. Let me pull them up on TradingView. You have them actually. No. Okay. Almost there. Give me a second. Yield curves from the USA. I'll pull this up. Should be on this stream, on the recording, and now I'll switch it here. Bang. Yield curves. Okay. Here we have the yield curve of the US. United States government bonds, right? And the yield curve. Type a 1 in the chat if you have never seen this. Okay. I already see one. Yes, this is US 10 to 15, 30, whatever. Okay, I see a few people don't understand this so far. We need to kind of, before we understand this, we need to go one tiny step back. Bonds, bond market. Type a 1 in the chat if you have no clue what a bond is and its yield. But I think most people probably already know, most likely. Okay, so when we have government bonds, right? Basically, anyone in here, you or me, I know you and I have a strong bond. um, anyone in here can buy a government bond, right? I can go to my bank and say, hey, I want to buy U.S. government bonds, right? And then I get a list of options, right? I get 1,001 bonds that I can choose from. They're instruments, trading instruments. Basically, what it is, it's like a loan to the government, right? So what you can do is you get a bond, and let's say you buy $1,000 of a certain bond, right? Then you kind of have to determine, okay, I'm giving the government $1,000, right? What do I get in return? Well, hopefully I get some interest on it, right? Because I'm basically loaning them money. It's like reverse bank, kind of. What's the important deciding factor to decide how much money I'm gonna get, right? What's the other side of reward in a trade? Because basically it's a kind of a trade, right? What's the other side of the coin of rewards? Tell me. As traders, you all need to know this. Risk, exactly. Risk is the other side of the coin, right? If I want a certain type of reward, there is usually a certain type of risk on the other side, right? As a whole, government bonds, especially from the USA and larger countries, are relatively safe investments, right? You're not taking on a whole lot of risk, let's be honest, right? The likelihood of the US government paying you back is pretty big, so the risk overall isn't that high, right? That's why usually bonds do not have the same rate of return as a stock market, right? In the stock market, you're taking on much higher percentages of risk compared to a bond. So here we have 1M, 1Y, 2-year, 3-year, 5-year, 7-year, 10-year, 20-year, 30-year, right? Now, who is taking on the most risk in here, right? And let's look at the blue one, right? Which is the current one. Yeah, if they can't pay you back, you have bigger problems, right? Who's taking on the most risk? Someone that holds a bond for 2 years, right? Or someone that holds it for 10 years, who's taking on the most risk. Okay. Jesse says, or Jesser says 10 years. Longer duration is riskier. Exactly. You are in the market for a longer period, so you have more exposure to the market, so you also take on more risk, right? That's why usually the values of the 30-year and 20-year are much higher than the ones in between here, right? So a yield curve basically plots interest rates, aka yields, of bonds with the same credit quality but different maturities, right? And basically, you can read what's happening with an economy based off this curvature here, right? There's different curvatures that occur, and they tell you different things, right? Let's say the yield curve, right, the blue one, is completely flat, right? It's flat. So yields are pretty similar across maturities, right? Usually that means there's uncertainty in the market. It's a transition phase where markets are, it's unsure if there's going to be growth or if slowdown is going to be ahead. People do not really know, right? It's uncertain. Let's say we have an inverted yield curve, right? And an inverted yield curve basically is this, right? Short-term bonds or yields are higher than long-term yields, which usually is not a really good sign. Usually it means that the market expects a slower growth or recession coming up, right? And it's often linked to the Fed being very restrictive. So inverted ones, like the one we had 1 year ago, is not something we want to see, typically. We also have a steep yield curve, which basically means long-term yields are much higher than short-term yields. And this tells us there's strong growth, there's inflation expectations, and maybe early cycle expansion, right? Which is technically a good thing for a economy because it means there's money coming into the market. People want to take on the risk for the long term. People want to keep money flowing into the market. And then we have a normal or upward slope, which means longer maturities have higher yields, right? Which is just a normal one like this. And this just basically means the economy is expected to grow, right? The inflation risk is in check and the Fed is likely to tighten gradually. What we can see here, and this is nice because here we can see if it went up or not, is that the blue one is the current one, right? And we can see that these ones, the short-term ones, are a little bit higher, and then we slowly go up the more further down the line we get with maturities, right? Now, these different bonds, they do not only move based on expectation, they have certain functions to them in a way, right? And what are these functions? Well, we have the short end bonds, which is basically the 1 month all the way into 2 years, right? And these bonds, they are very sensitive to the Fed policy, right? Why are they sensitive to Fed policy? Well, it's because whenever the Federal Reserve makes a change in policy, right, that change will be reflected in the short term, right? So what happens is these are more volatile because they're sensitive to what the Fed is going to do in the short term, right? If the Fed makes a choice now to cut rates, for example, is that single rate cut going to matter in 30 years' time? Most likely not, right? So these 20 and 30-year or 10-year ones are not really affected by short-term decisions a lot, right? Then we have the 10-year and the 30-year one, 10 until 30, and these one are the long end bonds, right? And they reflect growth and inflation expectations. And these are important because if people or traders or market participants or investors or whoever buys these bonds are expecting the market to grow over a longer period or the economy to grow over a longer period, you need them to be sure about it, right? And if they are sure about long-term growth, these will be higher, which is better, right? And then we have, for example, spreads. right? And it means the federal funds rate has a positive correlation with yeah, well, the federal, yeah, but that's because the government basically releases these bonds, right? It's the U.S. Economy, or the U.S. Government, that releases the bonds, right? And they release bonds with interest rates according to market standard, which is the short-term interest rate, aka the federal fund rate, right? So that's why bonds always have a similar rate to the short-term interest rate, because basically that's why they have that same rate. That's also the reason why bond prices and bond yields are inverted, right? They never move the same way. Or they should not, let me put it like that. So how do you read a yield curve chart, right? Well, you first check the overall slope. Is it normal? Is it flat? Is it inverted? You look at the short end. Are the front end yields rising, right? If so, it signals usually that the Fed is tightening, or expectations are there for higher policy rates. You look at the long end. If falling, let's say they are falling, right? Going down while short rates are high, it means the market is kind of pricing in slower growth. You compare to the history, has the curve steepened or flattened recently? And that change matters more than the static screenshot, right? That's why in the end of month recap, I always include a picture of the bond yields and its history, right? Because it's important, it's important, A, to understand what the yield curve is at the moment, but B, it's more importantly to understand how it's developing, right? It's more important to know what it's doing rather than what it looks like. And what you can also do is watch key spreads, right? So, for example, you compare the difference between the 2-year minus the 10-year, the 3-month minus the 10-year, for example, to understand the spread in between them. So, important to note, inversions, what we know from fair value gaps, but it's a different type of inversions. They usually often precede slowdowns, right? So risk assets can still rally for months, but you need to watch credit spreads and open interest, because those will give you signs to see if the market's going to go slow down in the future, right? If we're steepening from an inversion, it could mean that the Fed is going to cut rates, right? Or markets expect higher inflation, right? Which would be a bigger steepener. Let's say they start to flatten like rapidly, very fast. It usually means that the tightening cycle is in full swing, right? Often it pressures equities as well. So, for example, we can see, let's see, the 2-year yield is 3.74 right now, right? And the 10-year is 4.2, right? Or let's say we have the current 1 month, right? And let's say the 10-year is 4.2, right? It means that the 1 month is right now is higher than the 10-year, right? So the market sees this as the Fed holding policy tight on the short term, right? But they expect weaker growth and lower inflation down the road, right? So later on. Any questions so far about the yield curve? Because I know I've been just yapping off for about like 10 minutes about the yield curve. I know Josh asked a question about it. Yeah, a lot of information to process, but let me know if you have any questions about it. I'd be happy to explain, or any specific things, how to incorporate it with other stuff, anything you'd like to know. Or maybe something else apart from the yield curve. Maybe there's something else from the fundamental side, or anything else you'd like to know. maybe about central bank policy, or I don't know, anything you'd like to know. What's my trading split? Basically, push pull legs or push pull skip. You would always monitor the 10-year because of your background, aspire to be real estate, capital markets. Ah, okay, interesting. Personally, I always also use the 2-year because the 2-year is usually used to reflect on short-term interest rates. Can we check how much invested to U.S. government or other countries, like buying bonds? As in, how many people are buying U.S. government bonds? Let's see. So, if I understand your question, you kind of want to see um, if people are buying bonds. Yeah, I mean, it is possible to see through COT and stuff. For example, you can apply the COT on bonds. Reasoning for 10-year for real estate was primarily due to the typical office lease time frame rather duration. That's interesting. I have never looked at it that way. Is it important to check? Yeah, not really. It's more important to check what the bond prices and bond yields are doing rather than who's buying them. Um, I'd say that's more important for like the speculative instruments. So at least that's what I do. I don't really look at how commercials are positioning themselves on bonds a lot. I'd rather see what the bond is doing. But I mean, if you want to check it out, you definitely can. But it's just I'm not gonna check the COT for 20 different assets. You know, I could, but it's equivalent to 7 years. Yeah, that could be the case. I'm not sure, but it's definitely interesting to check the rate cut or the rates with the real estate market, of course, because they definitely go hand in hand. I mean, the real estate market is like a what, $10 trillion market. So, and if interest rates are going to be lower, usually people are going to be buying more houses, and the other way around, right? If interest rates are going to be very high, people are less likely to buy houses or extend their mortgage, for example. Yeah, it is fun. It definitely is. Yeah. Yeah, the US have to pay 2 trillion this year, so if it's true to it affect economy and how markets react. Yeah, it's basically a never-ending cycle with the U.S. having to repay debt, man. Honestly, the government debt is so high. Thank you, Alex. Appreciate it, man. Appreciate it. Thank you for being here. The M2 money supply. That's an interesting one. Let me pull it up. Let's pull up the terminal. Okay, I don't know what that is. And then we'll do M2. Economy. Wait, I have it here. Or do I? I do not. I thought I had it here. Yeah. Oh, there we go. There we go. US money supply. M2 money supply. Does anyone know what this is? Basically, it's a broad measurement of money supply, right? There's multiple forms of money supply. There's M1, M2, M3. There's multiple ones. M2, yeah, bringing new currency. Yeah. Okay, so there's M1, which is basically the narrowest money supply, right? And it includes physical currency, checking accounts, for example, and other checkable deposits, right? Basically, essentially, M1 is like money that's spendable right now in the most liquid form, right? For example, the cash in your wallet and everything in your checking account balance, right? Then we have M2, which is a slightly broader money supply, and it includes like everything that's in M1, and then also saving accounts, small time deposits, retail money market, mutual funds, right? So basically, it captures money that's almost as liquid as M1, but can be converted to cash or checking deposits quickly, right? Which might require a small waiting period or whatever. But um, an example could be like your checking account, your savings, and all the small money market funds all together, right? And basically, M2 is being used the most, right? Because it can reflect liquidity expansion in the economy, right? M3 is like the largest measure, and this also includes like large deposits, institutional money market funds, everything from the repo market, the euro dollars held by US residents at foreign banks. So it's basically a total liquidity. And that's not, I don't mean euro slash dollar, I mean euro dollars. It's a different thing. The euro versus the dollar and the euro dollar is a different thing. So yeah, that's basically a difference. So what was the question, by the way? I missed it, I think, about it. What was the question? Just a difference in them, or you want to learn about them? Gonna open a textbook then, man. Hey, no, I'm kidding. No, so basically people use M2 the most, right? That's the one that's being used the most, and you can see like quick liquidity expansion in the economy, and usually like a large growth in M2 usually precedes like high inflation and asset rallies, right? And if we look at it at a timeline, and we can see 2022 or 2020, sorry, which was when COVID started in February, right here, or March, sorry. It's when M2 rapidly starts going up, right? 2 years time, they added what 6 trillion to the M2 money supply, right? Which at the same time, what was happening in the markets, up only, right? Then we had the bear market, which happily coincides with this one, the kind of drop in the M2, and now it's going up again, and it basically reflects equity markets at the same time, also a little bit, you know. By the way, Josh, I just got a message from the Scripty bot for the transcript. I'm not sure if it's stopped or not, but I got a message from it. Don't worry about. Okay, all good then. Any other questions that we have that I have not answered so far? Any trading related questions? Also, make sure to keep your eyes open for the next stream because we're gonna continue the trading psychology stream soon. We're gonna talk about the fear of losses and how to overcome it. Most likely gonna be a duo stream again. Well, yeah, what kind of streams do you guys enjoy the most? Psychology ones are nice. Good to hear. Most streams. This and psychology. Yeah. I mean, trading is very fast. You can basically talk for an hour about a 1 second chart and everything that happens on there. But at the same time, you can talk about a 1 month chart and also be talking for an hour. So there's so much information about trading from the 1 second to the 1 month. It's unbelievable. But yeah, it's basically the whole the way the world works. So of course there's a lot of information and a lot of stuff about it. International, but what would you like to know about them? Like Euro bonds and UK bonds? What about them? How they compare in risk? You don't even know their tickers. Man, you trade the 5 second chart, but you don't know bond tickers? AU10Y, yeah, that's for example the 10-year yield from Australia. Those tickers usually are pretty the same on TradingView, right? If you do 10-year, basically will tell you. Okay, yeah, you gotta put the country code before it. So UK 10-year or AU 10-year would mean Australia 10-year government bond yield. Yeah, ZB is like the 30-year bond future, not the yield, but the future. Are they heavily correlated? Correlated to what though? Yeah, you have ZB, ZN, ZF, ZF, ZN. Those are like 10-year, 5-year. No, I don't really look at, government bonds or whatever from other countries. I usually only look at the US ones because I only trade US markets, right? So for me, it's not that necessarily to look at what the Australian bonds are going to do, right? Yeah, doesn't really make a lot of sense for me personally. Like if yeah, you know, technical analysis on bonds, you can do technical analysis on bonds for sure. Yeah. International indices, like what, the UK 100 or FTSE or FTE, those kind of things, you can trade them for sure. I know the even the Dutch index works with ICT. I can show you. IX. I'm not sure what the ticker was. Futures. FTI. That's it. This one. Even the Dutch index works with What the is happening? I just want FTI. These are like, oh yeah, you can already see it. Even like Dutch, and this is like a small index, right? It's not that big. I mean, the Netherlands isn't that big of a country, so isn't our index. We have a few big companies, though. We have like ASML, which is a pretty important company, but overall, ICT concepts still work on this. I mean, if you look at this, it almost kind of resembles a Nasdaq, doesn't it? It kind of follows it the same way. Although Nasdaq has been going higher, while Euro or Dutch in the Dutch index hasn't been going higher at all. Been grinding down slowly. But yeah, you could apply IC concepts the exact same way you would on any other index on this one as well. In my experience, it works. Same goes for the DAX, for example, which is the German index, right? Oh wait, that's the wrong one. DAX futures, FDAX, sorry. You can see that the DAX is doing slightly better than the Euro one or the Dutch one. Not at all-time highs yet. Pretty interesting to trade, especially if you're based in Europe, honestly. Let's say you don't have time to trade the New York Open, for example, at 9:30. Maybe, for you, it might be better to trade the DAX. I know some people trade the DAX and it's perfectly doable. There's a lot of volatility inside of it. Of course, the volatile periods are a little bit different. 130 or 125, 120, yeah. Like 1 p. Yeah, it's like European times. You need to be awake at the London session to capture like the more volatile periods, of course. But yeah, other than that, You can trade this just fine. This is the RTH chart, by the way. Different exchange, different algo. Why? At the same, it kind of works the same way. Whether you're looking at European indices or American indices, the big difference is liquidity. How liquid they are. Usually, U.S. markets are a lot more liquid than European ones are. It's just because there's more money inside the market, right? So that's why you can see that like European markets, especially during downtimes when there's not a lot of participation, right here, that they're just very ugly and a lot of gaps and stuff, and that's stuff we do not see in the U.S. markets a lot. They tend to be very liquid, especially the U.S. bond markets are very liquid. So go. Have a nice evening, man. Enjoy. Thank you for still being here, though. Appreciate it. I'll see you soon in France. Gonna meet an escape member in France. Gonna be fun. Right. Let's see if there's any more questions or not. Otherwise, we'll probably round it up. I don't know if maybe Josh has something to add or something to ask. If so, let me know. You've been learning. That's crazy. I learned from you. You learned from me. We learn from each other. One big learning party. How to make $1 trillion? that's the $1 million question right there. How to make $1 trillion? Let me know when you find out. Probably step one would be to open a central bank. Maybe that might be the first step, and then just print a whole lot of it. Or well, um, you didn't specify which dollar, or you just said how many, how can you get $1 trillion? It depends. If we're talking Zimbabwean dollars, they have crazy hyper trillionaire, hyper inflation, so you could be a trillionaire there. I mean, pretty easily compared to the US dollars, of course. How to choose the correct assets? Good question. It really depends, like Josh said. I would like between correlated assets or pairs. Personally, I just stick to one. I don't really choose because I get I don't have a good experience with switching around. I don't like if I cheat on NQ, it, doesn't end well. So I cannot cheat on her. Every time I try to, I see a trade opportunity on NQ, and I'm like, ES actually looks better this time. I'll trade it. What happens is NQ goes to my targets, and ES just goes to the right, and that's it, just to the right. And I'll tell myself I'm never gonna do this again. I'm always gonna stick to NQ. And then a few months later, the exact same thing happens, and then it's like I shouldn't just switch. I'll stick to the same one. Like for some people it works. Some people they actually switch around from the acid, and it works perfectly fine for them. But for me, I don't know. I'm always unlucky with that. So I'm I was like, let me just at least be consistent and just choose one acid instead of switching around. I'll know for sure. There's definitely a few people in here that switch around like crazy, and it works for them, and I'm happy for them because it's not me. Yeah, Rafael, exact same for me. For me, just NQ. Yeah, Colombian peso, exactly. You could be a trillionaire in there a little bit easier than with US dollars. Although I think Colombian peso is still worth more than the Zimbabwean dollar. I don't think it has had hyperinflation that bad yet. For example, let's say in 2008, right? We had like Zimbabwe had its peak hyperinflation. So 1 trillion Zimbabwean dollars was less than like a bus ticket. So you would be a multi trillionaire there. You live in the Mag 7. The Mag 7. Yeah, we can. For anyone who doesn't know, the Mag 7 also stands for the Magnificent 7. I don't have a template for it. I should have it though. And basically, it's 7 stocks. The Magnificent 7. It's Apple, Microsoft, Alphabet, which is Google, for the people that don't know, Amazon, Nvidia, Meta, and Tesla. Right? These are like the big stocks. Yeah, you should create a template for that. This is like the big list of like this is the list with the 7 like large companies, and basically together they make up like 25 to 30% of the weighting from the S&P 500, right? And in the Nasdaq it's an even larger share. So, for example, the strong gains we had in 2023 until 2025, right? Were mostly because of these, right? I know there was a period where NQ was just going up day after day after day after day, and the only reason NQ was continuing to go up was because Nvidia was just carrying the entire market on its back, like it was piggy riding and just going for the moon. NQ Nvidia was just going up every day, and NQ was just following and riding the momentum. So it's definitely interesting to look at these platforms or these stocks as like a confluence as to what the market is doing, right? Because basically NQ and stuff is like a template or a watch list, you mean? Create new list. I think you mean this. We'll do AAPL. Oh, line chart. Oh yeah, we can do that. AAPL. Okay, I gotta clean this up a little bit because this is too messy for me. Yeah, I'll just create a new template when I have the time. We'll look at it for now from here, and then I will create a nice template. Oh no, not a new pane. Same. Move it in here. Right here. Oh no, they were locked together. What else did we have? We have 3 so far. Should keep it on percentages. Yeah, yeah, you're right. We can do it on percentage. That would be great. And then we add Meta. Same percentage skill. Microsoft. Nvidia. Tesla. 1, 2, 3, 4, 5, 6. And then Amazon 7. Okay. There we go. This is 0. Bottom line 0. And now I don't know which one is which. Okay, Google apparently has the most gains so far. It's going wild. So let's name it Google. Pink one is Nasdaq. Is no, not Nasdaq. Apple. Then we have Tesla. Amazon. What was the purple one? Meta. When I create a template, I will make sure to give each line um, the right color of the company so it actually fits. We're not gonna have Nvidia rocking an orange color. We'll make it green because it fits way more. Meta is gonna be blue, of course. We can't disrespect their marketing, of course. Uh, Click price line. What, I mean this one and then labels. Price line. Ah, yeah, okay, we can do that. That's nice though. It's good stuff. You see, I'm learning as well. You're teaching me new stuff today. Oh, there we go. This is better. This is perfect. Yeah, this is good stuff. Okay, well, just remove these names because they're ugly. Gee, that's crazy. I wonder why Google is on this side. We gotta remove Google. We'll do same percentage skill. Oh, now we can see that Microsoft's actually down since. So it's a 5-minute chart. We gotta go into a daily. There we go. This makes more sense. And yeah, here you can see the one that stands out the most is Nvidia. It's almost one-on-one the Nasdaq chart. It's almost the exact same thing. Like, I bet if we would overlay a Nasdaq chart with Nvidia chart, it would be pretty much the same. Yeah, we're gonna make a template out of this. It's cool to see. It also helps you because if the Mag 7 start to behave differently or start to break down, what happens often is that these ones break down earlier than the actual Nasdaq itself. What am I looking at? Yeah, right down here. You can see the intraday. Yeah, will be right here. I don't think I have the actual Nasdaq package though. I don't know. Oh, okay, it's by Cebu one. Okay, it's fine. All good. All right. Do we have any questions about the Mac 7 or anything else? If you have any last questions, throw them in the chat. Um, if not, that's fine. We can round up whenever we want. Um, by the way, also very important. Any feedback so far? Is there anything I could change? Anything I could do better? Anything that that might help me improve these streams? Because these streams are fun to do, and it's also good to have some stuff that we could improve. Because if there's something that we can improve, that's always good. What's my background? As in, like, what I studied. Funny thing is, you're never gonna guess it, and you're never gonna expect it. I, I majored in so okay, it's a pretty long list. I gotta pull up my LinkedIn for this one. 1 second. Um, so I started out doing college, right? Which is like hogeschool in Dutch. It means, yeah, literally translated, it's high school, but it's basically college, right? Bachelor's. And I did a like f- basically fashion college education, but narrowed down to management and um, everything like marketing theory, like innovative marketing theories, like theoretical part about marketing and like neuroscience behind marketing and that kind of stuff. Then, in my third year of the four, I suddenly realized this is not what I want to do. I'm not interested in this at all to pursue a career. So I was like, I gotta, um, I gotta find something else. And then I found trading. So then I was like, okay, I gotta, dive into this trading stuff. Then I went to a different school, which is in The Hague, which is like the city that houses like the government here in the Netherlands. And I went to the Hague University of Applied Sciences, and I studied fintech there, which is basically financial technologies. Investing and trading. I studied that for a half a year. Then I was like, okay, this is fun. This is good stuff. This is like right in my beginning phases of trading. And then I was like, I need to know more. So I took a course from the New York Institute of Finance, which is market structure science. So I did that. Then um, what else did I do? I took another course somewhere at IMF, at the International Monetary Fund, which is financial market analysis. Then a whole lot of self study, a whole lot of reading books, reading CFA books, that kind of stuff. Then I started to work at a bank, a pretty large bank, as an investment specialist. I learned a lot of stuff there, which was very fun. I got to work with the Dutch option markets and US futures market a lot. And then I quit my job at a bank and I went full time trading, analysis, all that kind of stuff. And then, you just pick up stuff along the way. Here you have him again, Raphael, with his deviations. It's always something. Yeah, get on stage, bro. Show us the stuff because I don't know about this. You know about it. Welcome in. Welcome in.
Hello, guys. No, I'll just take a quick look on your charts. I didn't do any measure on your charts. So, I mean, how can we see the screen that you were sharing? Get back to the
Oh,
screen.
oh yeah, yeah. 1 second. There, this one.
Yeah. Hold on. Yeah. Look. No, it wasn't this one. I guess you need to click the 1 day on the left, like Josh asked before, to the 1D. Yeah. And then, yeah, for some reason, I just take a quick look. It wasn't this one as well, but on the bottom side, it was 1.80%. So that's minus 1.786 on average. Where the a little bit down. Look, I have minus 1.80, and above was 1.6. So that would be 1.618. I mean, that was showing the screen before we change. I just take a quick look.
Yeah, so
Uh,
when you have the view like this, it's basically tracking the percentage at the time of the left of the screen. So depending on where you are on the left of the screen is where it's going to start counting the percent. So
Yeah,
that's
I
why
mean,
that's
the,
more or less
the
the
way that
Yeah, so here it anchors to
the way that
930.
the
Right here.
yeah, I guess you click on the daily, and for some reason the way that the chart looks was like the middle point was zero, the deviation on the downside was 1 point, shows on the right side was 1.80%, so that's the 1.786 deviation, and on the upside would show 1.6%, and that would be 1.618 deviation. I mean, now it's not looking like that, but was just like before.
Raphael just sees the deviations
Bro, I was
constantly.
just about to
So
say this guy,
shout
bro.
out to him.
We just see a simple Mac 7 in their performance, and this guy he just sees deviations. That's crazy. I love it.
Unbelievable.
I love it.
Raphael,
Yeah,
how
it
you doing?
was Yeah, good, brother. Yeah, I just I mean, sorry, I just got late to the stream. I got here was about 2 p.m., but was incredible. Nice to see that.
I bet
Beautiful,
you see
beautiful.
deviations in real life stuff as well. If you walk into the grocery and some groceries like laying apart, you're like, hey, that cabbage is like 2 standard deviations from the other one. I bet that happens a lot.
Yeah, because but basically right now was looking. Yes, look, above is like 1786, so 1.8% above. If the zero is the midpoint, and now the below is minus 1.6, so minus 1618. So we deviation 618 to the downside and 786 to the upside. So we always play inside this range. So beautiful. Just looking for the percentage on the right side
That's actually pretty interesting.
So he's basically saying
because
that
it's,
potentially the Mag 7 index like has a like normal, I don't want to call it, like let's call it normalcy of a stock that should go down no more than, pretty much, I mean on a normal day obviously, like
yeah. Yeah,
1.786.
usually you go up or down to 618 or 786 to upside or the downside, and then you can start to a retrace a reversal, and that's what the stocks did all the time. If you're looking for the zero point, some stocks went down first to the 1618, and later they get up, and other ones get up first and get back to the to the midpoint. So usually you go to a specific range, get back. If you break the starting point, you go to the downside, and then you get back to the midpoint. Basics like this. Even on the stocks, like looking for the daily or whatever. This is the this is for today. Yeah, the last this is last 5 6 hours. Yeah, and if you pay attention, why the Nasdaq usually on average moves 1.376%. If you do the average on this, probably you get something around that.
Wow.
If you get all the um, how each stock move above or below in percent, if you put all together and get an average, that would be close to 1.376%.
That's pretty crazy.
Interesting. Very interesting. All right. Well, I think we had one more question in the chat. I
Yeah.
don't want it to be, a miss. I think it's from Abdul.
Yeah.
And then I think we're gonna wrap up the stream here. But Raphael, you're more than welcome to hang out as well if you want to hop on
No,
the
it's fine.
charts and
Definitely.
see anything on
Always
on
welcome.
stream.
Thank you. Thanks, Rod. I just would love. I mean, it was just a small comment, but you guys finished that.
Yeah.
Thanks for the
Little
for
Raphael interlude. I love it.
Much love, much love.
Thanks, guys.
If I have any clue about yeah, I've heard about it. It's part of like numerology and stuff, right? I'm not too well versed in it to be honest, but like I know the numbers from the Bible, but I'm not too well versed in the other part, to be honest. Think it has to do with vortex math and stuff, but I'm not too well versed in it, to be honest. So I don't know. I don't know if I can answer your question. We can look at GC. I mean, we can, but we'll just open it in here. Futures. There we go. What's up with gold? Time frame 369 minutes. What does that do? Oh my god, this is ugly. Ah, it seems Raphael knows about it. It's the first prime, yeah.
Abdul, why don't you share your charts? Curious to know what you're seeing from this.
Yeah, so that's basically 6. And then you're looking at what? Oh wait, it's a little, I'm way back. 618. That's basically Fibonacci 618. Can you imagine? We went from yield curves all the way to this. Okay, so you told me to mark out which one, right? But I'm gonna. Yeah, let me see. Should we be 009? Yeah, and 18. Yeah, and then what? 618. And then what? What do I need to look at? I have heard of it before, Jason, but I'm not too familiar with it. No. Ah, okay. Well, thank you for sharing. Appreciate it. I'll take a look at it. Always be prime. All right. I don't think we have any questions anymore. So I think we're just
Right.
gonna wrap up the stream. I don't know if you have something to add, Josh. If you want to say something to the people still
No,
here.
I don't. I just want everybody to be able to, if they're still here and they're still watching us, just drop a heart, drop some love. We appreciate you guys. Thank you, Asana Time, for being here and having a great stream. We really, really appreciate you. And I look forward to having the next psychology stream with you. I know that that's going to be a very fun time as well.
Yo, yeah, for
So,
sure, for
if you
sure.
guys enjoyed it, definitely drop some heart, drop some love in the chat. We appreciate seeing it and keeps us going. And we will talk with all of you guys next week. I don't believe that there's any streams tomorrow, but maybe there might be an impromptu stream. So just keep an eye out. Stay active in the Discord, and we will all talk to you guys soon.
Yes. All right. Have a great day, everyone, and thank you all for attending. And I'll see you soon.